Hello guys, welcome to Traders Therapy Session. I'm your host KRO. Without wasting any time guys, let me just get into this video. Our videos range around 15 minutes to 20 minutes. I'm trying to keep this thing short for other people, since other people have small concentration, and I myself will no longer be concentrating or interested if the video will take long. Hence, I struggled watching the ICT's video, but I had to train my mind to last for more than an hour concentrating. And the only way to do that, guys, the only way, if I have to share my trick with you, the only way to do that, to stay long on a video and concentrating, I only did that when I started talking to ICT as he was presenting. I started engaging, asking questions, even knowing that he's not going to answer me, pausing and asking questions, and then writing something down and going back to what he's saying. That's the only way, guys. You need to control me on your device wherever you are. Pause me, rewind me, whatever is it that I've said to you that doesn't make sense, write it down. See if you can catch it on a later stage in the video. If not, comment below, research about that thing. Maybe on the next video I will be presenting that thing. So without wasting any time, guys, I was just giving you that tip. This video, I know you will lose concentration. I will try to keep it short, but I need to tell you each and every details. As you can see, no much drawings that we put here. I just highlighted each and every trade, and this comes only from that. You need to watch the previous video, guys. You can never move on with this video without watching this video. The green side is the reward side, and then I've written the ticks here. So the risk to reward, you can see we have small 5-2, 1:2, the first one. I will make example, or you can have this screenshot right here, or you can just jot down activity. You can write from 1 up to 21, and then from 1 up to 21, forget about everything else, and then it's you D1 up to D21. Is it D20 up to D20? D1 up to D20, and write the risk to rewards here, and then you will see them as they form. That if you are not understanding, you are struggling, do that activity, guys. I am a teacher as well, professionally, so with 2 degrees. And this kind of a psychology is one of the learning styles, or the teaching method, or the learning style. I want you to do what we call breaking habit learning style. You are going to write 1 up to 20, D1 up to D20 on a piece of paper. Don't even take a screenshot. Just don't be lazy. Write it on a piece of paper. Then on your answers, write buy, sell as they appear. Pause the video and write this risk to rewards here. As I go to picture 1, you will reference to your page. You don't have to come here. You will reference to your page. You don't have to look at the news and everything, because I've highlighted the news on the charts. So there are news there. The only thing that you need, risk to rewards, and then look at you may not even write this. You don't need this. We talked about it. This and this. That's all. That's all. Let me go into charts without wasting any time. Okay. Sorry, not charts. Without wasting any time again, guys, I want to explain each and every detail on each and every slide. Maybe the first 4 slides I will try to explain, but you need to catch the speed, because certain things will leave them out. There won't be any need to explain them. So you need to catch the speed. Each and every chart, you recognize this line right here, this vertical line. It's a midnight open, and my chart is on New York time. Everything else that I'm doing is based on New York time. As you can see, 0000 midnight. This is a midnight open. Usually, I don't want to. Sorry. Or you can see on first 2 or 1, I've just highlighted this, but I don't want to do it. I don't want to dwell into the strategy, because this is a strategy on its own. For that, just a moment. Guys, sorry for that. Sorry. This I didn't include in each and every chart. It's useless to do that because we are explaining the kill zone here. And I am using a time minutes time frame because it gives me at least a space to see a price action. And you will see we are mainly targeting internal liquidity, not external, because we are scalpers, intraday trader. If we are taking an external, we'll just attack the high or the low. That will be it. So let's go for this one right here, and let me explain each and everything to you so that everything can make sense. Open after open, this is London. As you can see here with time, London starts at 2 a.m. up to 5 a.m. You can see it's before 5. So ever since London opened, it created the low. This is London low. This is the, let me see if I can do even further. Oh, sorry. Okay. If this will allow me. Yes. Before everything else happened, this was London. The London created low. Before London end, somewhere around here, I guess, maybe. Somewhere around here, maybe it's London high, or this is London high. It was taken out because it is taken out at a specific time. Between this time and before 9, it's taken out. Then we have the London low, like I said. London low, draw that London low. We can draw the London high if you want to. You wait. You have another internal range liquidity here. It was taken out. Taken out. Even this, it was also taken out. If you call this a swing high, that means these are the internal range liquidities, that the ones that I was showing you on this side. If you take this as your high, from this point to this low, you take this as your high. These are your internal range. It won't be perfect as the drawings, guys. You just have to train your eye to see such things. You have your higher high, higher lows, higher high, higher lows, higher high, higher lows, higher high, higher lows. Then you have those displacement right there. Then you have your entry. Maybe it's the one that caused price to go low or whatsoever. But we are not discussing that. I will show you exactly the move. We are not discussing the trade here. The trade we are discussing will be here. Then you wait for market to take either London high or London low. NYSE will occur before you trade, which is 9:30 when the market opens. And I want you to look at this. Look at the size of candles before the market opens, and look at the size of candles right after the market opens. And look at the size of the candles maybe during lunch and when the market closes. You want to take part on these big candles. So, as you can see, let's explain everything now. You have this low being taken out by this low, right? Or you have this low being taken out by this low, but you have this low right here, the one that I'm talking about. You have the other low. Sorry guys for the disruption. Is the reason why I like to do these things during the evenings or the mornings before everyone wakes up. You have, let me explain this model. You have this low, you have this lower low, then you have this high, you have the market taking out the high. This one is NYSE. You have it here. Look at this space. It's a displacement leg. You do not trade on a displacement leg, guys. What do? You wait for what? You do not trade on a displacement leg. What do? You wait for the retracement of a displacement, and you look for fair value gaps that occur during those displacements. And what do you do during that displacement? You wait for that. You get the fair value gap. It is better. The fair value gap, it's better when it has a breaker in it. So this is not a clear breaker. Let us not just get into it. Let's get into the news. This is just complicated. If I have to explain this is just complicated. I will give you the easiest one. You will see the easiest one. Market will come differently, but as long as you understand the narrative, that will be good. New home sales, it was 10 a.m., of which it was on my side, it was 17 hour. The news are there to do what? To start up the price after NYSE in most cases, or before NYSE. But the high probable trades, it's when you have your trade, your news coming out before NYSE or before you trade. They should occur there. Those are the news. That's what we want to. We want the news to be released so that we can start to trade. What do? Then the trade goes up. And what did we talk about the target? The high that caused the fair value gap needs to be taken out. Is your first TP. Or in some pictures, you will see me using what? You will see me using certain areas here just haphazardly. What are those areas? Those areas is when the market goes to lunch. It means I go out. Okay, guys, that's what you will look at. Usually when it comes to lunch, I move out, I go out. That will be it. Let's go to number 2. That was the previous one. Focus here. Here I came with certain things to tell me where should the price go, because you are not going to open the 5 minutes. Remember, you open the higher time frame like I explained before. You check where the market will draw to. As you get the draw on liquidity or inefficiency, you wait for a model to be formed towards that direction. Let's see what we have right here. We have highs before the market, before our market opens. We saw the highs. This, guys, this resistance here, the retails will call this one a strong resistance. We see these highs. It's our initial points to go for price now. Then we see these lows formed. Sell side London during this time we expect to take place. When it's taken out during this time and it reserves this, it's a good entry for us. We don't even have to go even further. So you can mark, guys, you can mark else anywhere. You can say you have low, you have lower low, you wait for this to come as a displacement and come here. Depends on your style of trading. But we are intraday trader and I am now training you. You better, you need to, not better, sorry for that. You need to repeat this video and communicate. Let the voice, call it before I called it, because you watched it before and you show the understanding. So I'm hunting here. I have to hunt for something. If I see this, there's low, there's high, there's low. You can say, I would have seen this. It's okay. It's fine. If you've seen this, you would wait for market structure shift, of which occurred here. Then you utilize that fair value gap. It's still fine. I see the low, I see the low, I see market structure shift. And this market structure shift, you see this candle. I see this candle as a breaker right here inside that candle. This is the reason why I even jumped into it, to see it as that. And guys, we are not saying we took all these trades. No. I had to do this to show you how the algorithm run. You cannot take the exact algorithmic trade every day. Remember, you are a human being. You have emotions and everything. So this, as it came in here, it went up. The breaker needs to have a fair value gap. Then the stop loss needs to go below. So number 2 is not 3 point something. Basically, this one, it's huge risk to reward ratio, because your stop loss needs to be below the breaker. The news, consumer index 10 a.m. is number 2. Number 1, it was 10 a.m. as well. Number 3. Oh, we went for this liquidity, and we have an inefficiency right here. This is the reason why price 10. Price doesn't 10. We have a fair value gap right here as a CB. Sell side imbalance, buy side inefficiency. So sell side was imbalanced. This is the reason why price needed to come back here. And they knew that the price will come back here. The market makers is the reason why this buy side liquidity was built here. Needed to come for that price to come back down there. So what should we discuss here? Before price occurred 810, liquidity London low was taken out. Then the price gravitated. We have NYSE. NYSE, when the market opened, look at the candles, guys. Look at the candles. Look at NYSE after market opened. Look at the types of candles. This is when the volume is in the market. And the news before you trade, it's even better. Your fair value gap, you enter. Your targets, even that one could have been your target. Let's go to number 3. The sell. This one, guys, this is the one that you should pay attention on, because this one is just a picture perfect trade. What do we have? Let's study the price. Before midnight open, we have the low that we carried out with. This one is for just for target purposes, for draw on liquidity. Then we have what? We have the London low. Can you see the London low? This is London low. We like to see it taken out. Then you'll have the London high, where before you'll have the London high taken out. Not important for now, because the London low was a draw on liquidity. You have price, power of 3, if you may ask, accumulation, manipulation, distribution. Accumulation, I don't know how you call it manipulation, but this for me it's accumulation, manipulation, distribution. But it's a breaker. It's the reason why I told you that you can find the breaker 70% of the time from that. And then this bearish candles, it created the high, the higher high that established. They are not, it's not one, they are there are 2 now. These candles, they are the ones that we call them a breaker. After we see the structure, it is better if your breaker has what? A fair value gap. And what did I say about the breaker? If a breaker, you go to the previous video, guys, and you will see what I said, what I talked about. If not the previous one for this, the one that I'll explain the breaker, it is better if when you, sorry guys, it is when you see a breaker overlaps with a fair value gap, it is better for you to take the trade when it tests whatever comes first, being it a breaker, being it a fair value gap. This is another example why you should do that. Because if you are waiting for a breaker and thinking that it will come for this, you would lose. This from the market maker model I recorded. These are just trap traders. Can you see an invasion fair value gap here? It was a fair value gap. It was disrespected. But can you see a new fair value gap? So it's a fair value gap with a fair value gap. If this is a buy fair value gap, this is a sell fair value gap, they subtract one another. There's no fair value gap. It's a balanced price range. Even this fair value gap up to this fair value gap. Only from here. Maybe only from here going down. This is the reason why I utilized even this fair value gap right here. This fair value gap worked and the market went down. Market structure shift. We're creating higher highs, higher highs, higher highs. We broke that high, we came back. Watch the previous videos where I explained with the drawings, because those ones are perfect. Then as it comes, we don't buy the displacement, but the fair value gaps, that comes with the displacement is this one, the retracement. First TP, it's here. Even if it's like this, first TP, it's here. It can turn back down. Then you can target the other sell side liquidity. Is the reason why I said on this one we're targeting internal range, internal liquidity. I mean to say, we do not go for external liquidity. If we go for external liquidity, we might go for single high, single low. That's it, because we are intraday traders, known as scalper. Number 4. Before the market opens, we had a relative equal highs, just like the previous one here. What is that? Relative equal highs you saw, and we took them out. We have relative equal highs, anticipate to take them out. Then we have the single low right here and other lows right here. So if we take this one, then these lows should be the targets, right? But with the help of the buyers and a higher time frame, The news unemployment claims, NYSE. Look at the candles before the news. Look at the candles. The news established the move. Look at the candles now after NYSE. Guys, this is in front of your eyes. If you cannot see this one, I don't know. NYSE before the news. Look at after the news. Candles become medium. Look at large candles after NYSE. So you want to wait until the market opens. This shows that the market is closed. You want to wait until the market opens and see your models. So this is one of the continuation trades. We are not going to focus on, of which is another model. We call it the silver bullet. It's a pure silver bullet here. You need to get some certain things again in order for you to utilize this strategy. But it's as easy as that. You have on, let me just explain this. 10 a.m. you want to see a fair value gap being formed on a 5 minutes time frame. 10 a.m. to 11 a.m. Then you can utilize the fair value gap that was formed before, like I did here, because it's time to trade. And or you can utilize the fair value gap that is formed during this. You see? Then to go with the trade. But you need to have a bias, because some would have lost, say, I know during silver bullet I have to take the fair value gap that is formed, and I have a low, I have a lower low, and I have a market structure shift right there, and then this is a displacement of which is not. Sometimes they will fool you around, because look at this candle. It needed 3 candles to be engulfed. So you could have been fooled out after the close. As you can see, even the respect of the fair value gap here would be your entry. You would have lost. But if the risk management was okay to your side, it's fine. You lost one. You lost just one of the risks that you have, of which 1 cow, 1 spoon, 1 everything. But you know, when you win, you get 2, 3, 2, 3, 4, 2, 3 of those. So you can get it back. All you need to do is to regroup. Let's go to number 5. As you can see, number 5, we have the high, we have the low. London low needs to be taken out at a certain time. Look at the time when it takes out. Like, look at the time. And tell me algorithm is not involved here. And then we go for the high. As we go for the low, we have this equal lows. Do you see the spike that is caused by PMI? This spike is the reason why, and then Powell is speaking. We are going to navigate the day of Powell if it was a buy day like this one. NYSE, but you still have this because we have a lot of news coming in. The news, you have an order block right here. You have a low, lower low displacement with Powell displacement. After Powell has spoken, you need to wait. Then you take advantage after he has spoken, because he brings what? News. So news, we wait for news, then we take the trade. That's what we do. Powell was speaking here. Then after Powell spoken, we have a displacement finally. Look at the willingness of the candles to go up, taking out that. And we remember that we have the London high. We can look for that now. Before taking out the London high, we have a retracement. Displacement, retracement. Guys, don't fall apart. I'm just training your eyes here. I know it might look long and then tiring, but follow. I'm just trying to train your brain to see these things. Trust me, it will work after this one. Displacement, then you see the fair value gap with displacement, but now you have to establish your breaker. My breaker is this opposite candle before. Then the opposite candle, I take the opposite candle and plus the fair value gap. Your entry here, fair value gap here. Where's your stop loss? Wherever your stop loss should be, below. Why would I enter here then if I put a fair value gap here? Sometimes you will need to wait. Remember, I have this order block right here. Can you see this? I needed just a touch of a body of the order block. Then that was enough for an entry to minimize the risk, I mean to say. So the target London high, you have that one. No worries. Let's move on. And then after Powell has spoken, let's go to another one. Was that 5? 6. midnight open, London low, London high. No news day. If it was an easiest day to trade, guys, this after this has been taken, we would expect this one to be like to be destroyed. But this is the reason why it is important to have this. This is this day, the number 6 trade, no news day. So no news day, we just catch the continuation. Simple silver bullet, the one that I showed you before. But here we are going to use this order block now. You see now how it shifted. We are going to use this order block, of which we'll talk about it on a later stage, not now. The price pulled, this is NYSE. It's a Judas swing. You better be listening and taking notes, guys, of something that is important. It's a Judas swing. I have a video where I explain a Judas swing, where I give a strategy how to trade a Judas swing. It is a Judas swing. Most cases, it will go on an opposite direction to fool you. After, it will go to the direction of the market. Going forward from this one, we'll take note of the NYSE. You will see. Once these are the things that are tipping, they're tipping the hand to say, man, look at me, I'm going there. When I come back, be ready. Then you be ready. Then after order block test, above the order block, we have the respect of an order block. Mean threshold is the 50% of an order block. It's called a mean threshold. 50% of a fair value gap or of a week is called a consequent encouragement. This one is mean threshold. Consequent encouragement is on a fair value gap or a week, because a week is treated as a fair value gap. Then you go to the low until lunch, I guess 10, or you just pull until you see price maybe denying, or using the previous PDR is there. The next day on the 7th, please let me remember the NYSE. The next day there are news PMI after the day where there were no news. Okay, this was taken out right here. I just took this and that, seeing this as a relative equal lows, or this will be taken low on the later stage. So you have this as a liquidity, looking at the price to come here, but you wait. Is it the time to trade? No. You wait. NYSE with its price, it's moving high. It's telling you that wait for me, I'm coming back. As it moves, we have this order block. The one that we see right here is the one that determines our TP, by the way. Don't worry, this kind of a models, when they leave, because where they leave you will even understand and tolerate them. Then it came here. It doesn't matter. I'm waiting for my time. I was supposed to buy here around 10 something here, because it's a continuation. This is a silver bullet target. The high, not this high, this high, because, oh, yes, it's a second hand. The first hand, second hand, it's supposed to be this high, of course. This high, it's your first TP. But it's not okay when it comes like that, because it's just a straight up continuation. Or you wait before lunch. You have your model, you have a high and a higher high. As you can see, as we move on, I start to eliminate certain things. Higher high, displacement, you cannot, no doubt. Displacement, fair value gap, breaker, opposite candles that established before. That your stop loss, your breaker is your entry, fair value gap together with the fair value gap. You see why you did not rush to enter here. You could have even entered here. It's even fine, because your stop loss is still protected. Yes, it was the entry for this one, and then you got your TP according to the fair value, according to the order block, I mean to say, right there. Then let's go to number 7. You have your relative equal highs for London. You have London low. I don't know why I did not put that one there. You have your London before 5, so your London low will be somewhere around here. You have your London low being taken out, guys. London before the time of trade, you have your news 8:15, it's fine, which is NDP, ADP. Then you have this taken out, relative equal highs. Displacement. You see a fair value gap that you don't count to. You have this swing low before this swing high. So this should be your what? This should be your breaker. I don't know why I utilized this. I should put it here again as well as it comes to test. Oh, this bearish, I mean to say this bearish move. It's okay. From here to here. As it tests the breaker, I have a breaker plus there, fair value gap right there. Stop loss above the breaker. What time to trade? This, I need to see this occurring at this time, guys. So you have to wait. Then we have unemployment claims. We have the London low. Somewhere here we have the London high, just as a buy side liquidity being taken out. NYSE tipping. This is the reason why I don't know whether you will say this was a buy or sell, but it is a Judah swing. This is just a pure trade. Okay, I thought it was a breakup. It was a pure trade because we are following is it the long-term highs right there? They are long-term highs. I don't know why I did not annotate them. They are long-term highs. This was a draw on liquidity. This is the reason why the price had to leave what? Had to leave these lows to go for that. Sorry, because it was most appetizing. It was the external range liquidity now, this one. So let's go to number 10. London low, same time. So those days, on these days, you don't know these models, stay away from the charts. These are the days that you're not going to trade. Or you will lose, but if you manage your risk well, you will still be on the game and be profitable. Coming here, this was the NFP day. Let's see. London low, taken out, banking the high. All-time highs. Which all-time highs? Even this one again. Remember? All-time highs. Then we took the low. You can say we have what? We have a low, a lower low right here. Market structure shift with the displacement, right? The pullback, fair value gap with what? With order block right here. The bullish candles right here as they come to test them back right there. Guys, to understand what I'm talking about, I know frustration is so high. Look at this on the drawings and then come back, then you will make sense out of them. Then that's when you get this pull. And look, when you enter, you enter based off these candles right here. Just to take this as a first CP, but there's a fair value gap which is new going back there that we're waiting for. After taking the buy side, after taking this buy side liquidity, I need an excuse of which was this fair value gap. So let's go to number 11. Oh, NFP. This was NFP news, went down. You saw the previous. I cannot even emphasize this more. Maybe it's for the fifth time now explaining whatever is it that I'm explaining. When NFP, I like to go the opposite direction of NFP. NFP is that obvious, guys. NFP is that obvious. When it sells, in most cases, as far as I've seen it, when it sells, the real move is buy. When it buys, the real move is sell. So stop this issue with these people who like to trade. They open, they go for a minute or so with their adrenaline rush being high. When you trade NFP, if you say you trade it like a pro, or if you have traded better than the way you see markets, wait for it to okay. Utilize that, show us that, utilize that and participate. It will give you a chance. It came, as it came down here, you see this, and this, you can either wait or utilize an advantage of that. This is what you will see me doing. I will utilize this knowing that this is an indicator. I'm not using indicator from the chart. This is an indicator itself. Then I won't be afraid of taking the buy from here, unless if it's the day to lose, then it will go low. But at that point, I will lose what? 1%. That's the most important. The punishment that I will get for this, it will be 1%, unless if I overdo it. Emotions comes in. Unless if I overdo it, then it's something else. Then we can come to this. You saw this fair value gap below your stop loss. You could have been in this trade from here, but wait. Remember, you are trading only one thing, one structure. Wait for displacement. You don't trade displacement. You wait for retracement But there's a way that you trade these things. So you rather master one part before you can adapt to another thing, before you can add it to your trading. Because you will keep on blaming the strategy if you hop from one way to another, one way to another. The pullback, you trade it with fair value gap that is on a breaker. It's even nice. Ever since we did this, I didn't show you the trade of an order block. I think I will have to show it to you now, because order blocks as well affects the no news day. Order blocks again affects the affects the market to 10. So they are very precise, but if you have a fair value gap, you are still fine. Then we have the buy side taken out right here, sell side taken out. What time? Same time. So you can look at this time if you're trading New York, pre-New York. You can wait for this to be taken out and utilize this as a trade every day, because you've seen it here occurring every day. Most days, let me not just say every day, before I'm being proven wrong. So this is when you come in before NYSE. You can even utilize NYSE to enter better than people who are trading NYSE there. You see from the previous candle, from the previous chart where there were no news, we utilized only just an order block. It occurs on the opposite direction. What does it tell you? Oh, when there are no news, I'm looking for certain trades like this to establish, even to go high. But you entered on an order block wanting, because you saw this, there's a 5-minute fair value gap, of which is a first hand. It was never ever mitigated at all. So this could be your trade, and you can utilize that to take a trade. Then let's go to the next one. Okay. London low, London high, London low. Taken out. Oh, London low, taken out. Like we said, how many times when I was explaining this, have you seen this? After taking the London low, price is moving high to this. This seems like a same picture. After taking the London low, okay, this could have been your loss. Okay, this was the same picture. Sorry for that. Let's go to the next one. You have the London high, London low, taken out. If you're using that strategy, you could lose here because you don't have other things that are telling you what to do. Then we have low, lower low, right here. NYSE. You have CPI. It's because it's that day. If you are a trader, you know that day. It's because it's that day, guys. It's that day. CPI, as is established highs, immediately, if there's a draw that we are going to, immediately that CPI high becomes the draw on liquidity. So you see how you utilize that as your indicator now. You utilize that as your liquidity. When it goes down, I am not more familiar with the CPIs than NFPs, because for NFP I can stand there and show it to me and trade it. But for CPIs, it's like a complicated relationship with me and CPI. I wouldn't, even if you can see, say it went down, I bought after. It's a complicated relationship with me and CPI, guys. But using the high, we have this low, lower low, market structure shift with displacement right here. Did you see with displacement right here? And then after displacement, look at what we have here. We have what? We have a breaker plus a fair value gap. What did I say? Breaker is entry if it comes before fair value gap, or fair value gap is an entry if it becomes a break. If it comes before what? If it becomes before a breaker. Little bit thirsty. So you're going to look at that. Your target, after having to go to a fair value gap of a higher time frame, you look at the model. That's what I told you from the previous videos. After pullback to a certain area, you start to look at the model or the lower time frame. You don't rush to enter here. You wait for displacement. As it comes to a fair value gap, you can end. As it comes to a breaker here, you can enter here. Your breaker is your stop loss. You are saved. Then you go after what? You go after the highs. Let's look at number 13. 7 more to go, guys. Number 13, London low, new day opening gap. Those are the other gaps, guys. Where the market will gravitate to. But this type of gaps, I let me say, I don't have to teach them now, but with what you have now, you are okay. With what you have now, you are okay. Then we have market taking out. But what I would like to let you know is a draw on liquidity. It's just like fair value gaps and wicks and highs. They will draw liquidity. It's a draw on liquidity. So when you see the market doing like this, most of the time it will bounce on that gap as a strong support, strong resistance. You will see it when it breaks that gap. I mean to say, it will come back and retest it. That's when we say support and resistance retest. That's when we talk about those things. Then let's analyze the market. PPI, the spike will come for sales. Okay, whenever you see the spikes like this, you know that the market will come to close for real. It just spikes and it did not take the low. The lows were not taken out before trading, but the highs were taken out. And then after highs, market structure shift, we can argue, but we have a market structure shift. As you can see, the low went below this low, even the candle closes here. Then we had fair value gap 1 and 2 fair value gaps. I know I said this. Look into this. I know I said this, the one that comes here, you should take it. This is a balanced price range, but which fair value gap? It's on the discounted area. You start to look at that, and as it consolidates there, you take advantage of that. If not, if you're scared of that, you wait for price, you take the second one. You have a you have this one as a displacement. If you go to lower time frame, you'll see this being a displacement. You have another fair value gap at 11. This was around 10 something. At 11 exactly, you take advantage of that fair value gap, then you go for your lows. And this was FOMC, and it's the reason why we were struggling to get this entry, because of there was high impact news to occur, just like NFP. So this was an FOMC news occurring after whatever the price did there. Then we come and we on number 14, London high. If you can check right there, we have high, we have high. Okay, we have a London high that we are chasing. Then we have this liquidity that was closed, the one that we took out. We have this liquidity that we're focusing on, but we have a fair value gap from the higher time frame. Previous fair value gap, let me see, it doesn't occur here. We have a fair value gap from higher time frame. What needs to be done? Obviously, after having to take out this liquidity, look at the week. My eyes here, we're gonna come back for this. NYSE occurring, we took out the highs. As we come back, are we satisfied? No. After taking out the highs, we need an excuse, of which is this fair value gap. Then as it comes to this fair value gap, this is a breaker. This right here, 1, 2. But it should even come even here. Okay, it doesn't matter. Then you have your fair value gap inside your breaker. Right there, you go low. This is another type of a trade, simply because we have 2 news events, and then this is a little bit more advanced. This is a little bit more advanced, what I'm about to show you right now, because we have 2 impact news before the trading hour. This is the reason why this happened, but you could have attacked it, both with buy coming back with sell. Both sides, you could have just attacked it. Yesterday's London's high, Do you remember this London high? You see, we drag it to go far. The reason why it was not taken, it was banged. Because you see, this Swift, even this one would have expected to be taken out. Just maybe after this to come and take it out, but it went even further down. So we catch up with price. I guess this 1 hour fair value gap is not this one. No, this one is just something else, of which I'm going to explain now. We have a consolidation right here, of which this consolidation, I called it a original consolidation because I have another view here. Why? Because I had this one. I can say this is I utilize this low and that, this market structure shift. Displacement, I can call the displacement, but I was disturbed by this. But there's another way to show me to read price because liquidity was taken here. Then we have fair value gaps with displacement. This is just a week to take out the price, to take you out, but utilize. See this invasion fair value gap right here. We have invasion fair value gap, the fair value gap that was disrespected, and the price came back into it to go up. That could have been your entry. You would wait for price to close this first candle to see if the price is willing to close below, to call it a reaper or invasion. So it's an invasion, original consolidation. Look at the evidence from here or from here. This was the evidence. Then we went away from original consolidation. As we come back to original consolidation, this is your entry with or without a fair value gap. Come back to original consolidation because we are going for this high. Then we go there. We are building up what we call a buy side of the curve on a sell side, on a market maker sell model. We are building what? A buy side of the curve. Then you wait for price to do something else right here. That was going to be your entry to sell, and you see this sell, compression and expansion. Then you could have got your trade right here as it comes back. So this was the trade, and we had an order block right here. You could have respected that. Then looking for the trade. This is more advanced, guys. This is more advanced. After you have understood what I've given you. No trading day, expect the unexpected. Remember, on the previous two, no trading day, we'll get this order block and react off of it and leave. This one, we have relative equal highs, and then we have sell side liquidity. Do we expect to take out the liquidity if we have a day like this? We don't expect the market to be perfect. Relative equal lows, previous day's high. This is a draw on liquidity. It's a target. It's a high. This is when this is a external liquidity. So price will want to go there and look for excuse above that. Plus, it's not trading day, and we have a fair value gap coming in after taking out the liquidity. But we know we have to take this, even if we want to come here. But we have to take this. That's why your buyers are very important from the higher time frame. From the higher time frame, before you come here, you need to know where you want to go. From your hourly and 15 minutes time frame, you need to know where you want to go. Then you come here, you utilize those structures and everything else. Sorry, but if you don't have that in mind, you will see, and the time is very important. Otherwise, you will see the structures everywhere. Let's go to number 17. We are moving. No trading day. Number 17, no trading day as well. No news day, I mean to say. We have this London low. Do we expect it to come and taken out? No, because it's no trading day. So we took the high. Okay, we have this high right here, taking out the high, following the, and at this point, look at the time. Look at the dates. Where are we? We are on December. When was this? Picture number 17. Let's see picture number 17. D17. Look at the date. We are on the 19th of December. What is happening on the 19th of December? We were still on the market maker model, the one that buy from the day. So even with the market maker model, the one that I have just released last month or 2 months back, we were still dealing with that price. So we still have the higher time frame buys. So you could utilize that if you were asking me why buy here. And then I said fair value gap was used in this example because it came before breaker, not a bargain, but eventually price tested breaker. Price tested the breaker. Okay, we have a breaker right here, as we have the low and the lower low that we need to take care of, and then going forward. But look at this price, guys. Look at this. At least this time it wanted to come in here. If it's not trading, it's no news day. It's when we see that continuation of a order block and price moves up. And another thing, guys, I said I never talked about the order block. We said the order block is the last candle that takes the liquidity before the movement is established. Look at 1, 2, 3 candles. These candles, they take out the liquidity here, and then the move established. The price came back into this, and then into this order block. This order block, stop loss, it can even be below the order block, then come into the order block, and then it moved above. So it's the reason why I said most cases, and it's an order block because it has a fair value gap. In most cases, you won't be needing that because of the fair value gap part. Then let's go to 18. We have a fair value gap during news. Was there news? Yes, CB consumer confidence around 10. We had a fair value gap during news, and then we disrespected it before news. What do you expect? This is where we talked about invasion fair value gap. This fair value gap, and it's a second-hand fair value gap. This is where you find me talking about second-hands. If you can look at this right here, this is a fair value gap, the one that you have here, although on a higher time frame than this one. We had it like this, but this is a fair value gap. We tested it here, you see, but the close here, it's a sign that we have invasion fair value gap. What do you do with an invasion fair value gap? What did I say? It needs to test. What are sensitive areas? 0, 25. Can you see the reactions? 50, 75, 100, 75, then we established. So wherever the invasion is tested, you have it below, then it went above because the market wanted to move high. You had what? You had this external liquidity right here, I guess. Yeah, you have this external liquidity that you had to take out here. So this one, and then we left this. Then immediately after that, we came for this right here on an afternoon trade. We are not focusing here. If we do the same thing with an afternoon trades, you will find a similar pattern, similar thing, similarity. What happens every day? So we have this London low when it's taken out. But because relative equal low, this cannot be a London low. This should be relative equal low because London started here. See, it was taken out late. Okay, we have final GDP. And then we have the London high taken out. Price came back. There were no trade. We can even you can pause and try to find the trade here. There were no trades here. Unless if you see this fair value gap right here as your entry, but where would be your stop loss? Because it's NYSE. Like there were no trades, guys. I wouldn't lie. You could have lost or stayed away. Then the 20th one. And now that we have London high, and then we have London low as our target. Do you see what you target every day? If you can record my weights, use and maybe try to take my weights, use an AI that can show you the weights that I use. And see the value, see how many weights did I use, how more weights I've used here. I've emphasized this time, this highs, this highs and this lows. I've emphasized during the events. I've emphasized what happens in the events, what happens after NYSE. This is when we closed, I guess, before Christmas. Then you have that. You have NYSE, market pushing high, market pushing low. This is a mitigation now, of which is a pattern that I didn't even want to show you. And then you have a fair value gap testing that, then the high, or the high above here. It could have missed you maybe. Then you go for the low. London low. It's your low. It's the reason why it took the low and it went out of everything. So guys, without wasting any time, I hope you enjoyed that. And it's very important, guys, to repeat this. I know some of you might say, no, I've just catched that one with one video. But trust me, the power of repetition and habit. If you can do this thing, you can watch this video for 5 days. Make sure that each and every day you watch this video. After that 5 days, trust me, you will be a different person. If you can watch this video uninterrupted for 5 days, after that 5 days, trust me, you will be a very different person analyzing the market. You will see the market differently. Sorry, you will see you won't even argue with me. You will see what I'm talking about. It really happens in the market. So now, guys, my job with you for 2023, it is done. If I post anything, and we have less than 3 days, if I post anything that will be not based on that will be not based on the 2023 bus driver model, but it will be the examples that I will show you. Maybe if I find something, but I doubt I will find any good trades that I might even be willing to show you. If I find something, I'll try to show you, and with explanation. But guys, please, I have taken a trade like this. I was watching as I was preparing to expand this and cut it here. I was checking what did I share before with you on the 2023 model. I was watching those videos. You can imagine I was rewatching those videos, and I found out a lot even before I've shared. So there's a trade like this of which I traded live, and I explained why I don't want to trade live, because as you can see, there are a lot of things that have been seen here. So I don't want to be caught up explaining certain things while forgetting that I'm in a trade with you guys. Is the reason why when you see me trading live, I just annotate. And I have this other live trades that I took. I felt it needed more edits. So I felt like it takes a lot of time, but I will see if I can edit that and see if I can post it. But nevertheless, guys, I've given you everything. Thank you, guys, for those of you who watched the course and followed the instruction to the latter, and then I wish you nothing but the best in this journey. And whatever is it that you gained from me, you can utilize it and then maximize it in a way that you will go back and study ICT. And now when you go back to ICT, but give this thing a chance. Give it a month of practice every day, no miss. Give it a month of practice every day, no miss. Then as you do that, you will understand. Trust me, you will understand. Then you can go back to ICT, start with 2022 models. You won't feel drifted away anymore. You cannot feel drifted away anymore. Then you will study ICT. Whenever ICT is speaking, things that you will understand, and some of the corrections will be made, but of which I tried, the way that I've been explaining this is the way that I understood and comprehended it, whatever is it that the ICT has taught. So this, ICT is the pioneer of this, is the founder of the strategy. Then I happened to learn from him exactly. So I tried not to get it from others, although I was watching other people who are teaching ICT strategies, of which who are good, but I tried to learn from him and bring it back as a second hand. So after having to get this second hand, you cannot just go and buy a new car while you're learning to drive. this is what is happening. You got the second hand. After the second hand, study the second hand, study, master this. Then you go and revisit and visit the ICT 2022 models, 2023 model. You will see how easy and interesting that will be for you. But do yourself a favor. For the whole month, give yourself a journal. Write each and every day, what did you study? You study this, this, and that. You study this, this, and that. You study this, this, and that. The time when you go to ICT, everything else that you've studied here will be very, very much like everything will be easy. You will even wonder why you escaped ICT from the beginning. But the reason why I had to endure even the time that he was using, like he could teach for 5 hours, it was because I had an idea of price action. You see, before I learned ICT, there's a course that I've put here before. So for me, it's something that I needed. I had questions with retail trading. I had questions with price action patterns. I had questions even with structure, higher high and higher lows, just that higher highs and higher lows. I had questions with that. I was even using the high confluence trades whenever I take trades, but I had questions, then I got answers. This is the way to trade. This is how you need to trade. Without wasting any time, guys, for spending more time with me on this thing, let me catch you on the next video.